Hello everyone, welcome back to the new lecture. This is going to be a beautiful lecture where we are going to see lots of calculations and there will be lots of concepts involved, and the most important concepts like beta, capital asset pricing model will all be discussed in this lecture. So this is a question in front of you. Have a look on the question first and then we are going to discuss the concept when we will be solving the third part. Okay, Mr. Gupta is considering investment in shares of R Limited. He has the following expectations of return on the stock and the market. Okay, so in this question they have not given you the returns of the two stocks. If you remember the previous questions that we have discussed till now, most of the questions involved the returns of two different stocks shares, but here the stock's return has been compared with the market's return as a whole. Now there is a reason behind it, because the concept beta, understand, the concept of beta is connected to the market's return. Okay. So what has been given to us? Calculate the expected return, variance and standard deviation of R Limited. Now first of all, expected return. Whenever we want to calculate the expected return of a single asset, we have to understand whether the question specifies about the probabilities or not. It is with the probability, so we will apply the formula with the probability, which is nothing but summation of return into probability. Okay, first we are going to multiply the return with the probability. So 30 multiplied by this, and then the total will be the return. After that expected return will be called as bar Ri. Okay, we are going to deduct this return 30 from bar Ri. Sorry, we are going to deduct this expected return from 30, then 25 minus bar Ri, 40 minus bar Ri, 20 minus bar Ri. This is going to give us deviation of our expected return from the exact return. These deviations can result into negative figures, and that's why we have to remove the negativity. For that purpose, we are going to put a square. So the next column will be of squaring this column, deviations column. Then we are going to multiply it with the probability, and then we are going to do the summation. This will give you the variance of the stock. And when this entire figure will be, when this variance, when we are going to put the square root on the variance, we are going to get the standard deviation. So this is a process of expected return, variance and standard deviation of R Limited. Exact similar will be the process for the second calculation for the market. Okay, so by this time you will have the return of R Limited, standard deviation of R Limited, and also variance of R Limited. Then return of market, variance of market, and standard deviation of market. I will just write it in a sequence. Variance of R and standard deviation of R. Okay, now you can clearly see these figures are ready with us. Now is the point to find out beta coefficient of R Limited shares. First of all, beta, the meaning of beta is systematic risk. Now the standard deviation SD is a measure of total risk. Okay, the standard deviation that we have been calculating in the previous question is a measure of total risk, and it can be divided into two parts: systematic risk and unsystematic risk. Systematic risk is a market specific risk, and unsystematic risk is a company or industry specific risk. What do you mean by, sir, market specific risk? Market specific risk means risk that is applicable, or risk that will hamper or affect all the companies in the market. Affects all the companies in market. And what is unsystematic risk? Sir, it affects the specific stock that particular industry or that particular company only, not every, affects specific company. So let's take some examples of systematic risk. Systematic risk is a market specific risk, sir. Understand, market specific risk which affects all the companies in the market, and none of the companies can avoid that risk. Let's say for example inflation occurs. Now which company will be able to successfully avoid the inflation if it is happening in the entire economy? No, the impact of inflation will have to be accepted by all the companies. Inflation, we can say war between India, Pakistan, change in government is changing. It will affect mostly lots of companies. Then let's take some examples of unsystematic risk. Strike. Now why strike is an unsystematic risk, I will tell you. What are the chances that all the companies in the entire economy will go to strike at the same time? Very less. Like rare, or we can say almost impossible it is, right? So strike is a company specific risk. If it is going to happen, it will happen in, let's say, banking industry, but it won't happen at the same time in the automobile industry and the real industry as well. So it won't affect all the companies in the market, unlike systematic risk, which is affecting all the companies in the market, right? Strike, change in the CEO, death of the CEO, or we can say resignation of the CEO of the company, fire, financial statements. So if there are losses in the financial statement, it will be in some companies balance sheet. Not all the companies balance sheet and profit and loss account will show losses on the same year. So these are kind of an risk which is company specific risk. Now my question to you people is like, which type of risk can be avoided by the investor or reduced by the investor? Do you think you can reduce unsystematic risk in your portfolio? Do you think you can reduce systematic risk in your portfolio? The answer is you cannot reduce systematic risk, because no matter where you invest, all the companies will have to bear the impact of systematic risk: inflation, war, government changes, etc., etc. Okay, let's say I have invested in banking industry, and one of the stock is ICICI Bank. Then real estate industry, I don't remember, but Poonawala, or what's that name? Piramal, I think. I don't know that's listed or not, but let's take the name. And then we can go with automobile industry, Tata Motors, Mahindra, and so on. Okay. Now let's take the impact of inflation. Do you think the inflation can be avoided by any of these companies? No. The impact of inflation will go through all these companies. You cannot avoid it. Okay, but let's take the example of strike. If the strike is going to happen, it will happen in one of the companies. ICICI Bank bank employees will go to strike, but at the same time, I don't think so Tata Motors employees will also go to the strike, right? So strike is something which can be avoided, or unsystematic risk is something which can be avoided by diversifying your investment. So what you can do is you can put your investment in different types of securities, and what will happen is that the impact of unsystematic risk will get reduced. The moment you will start diversifying, the risk will get reduced. So yes, market specific risk in a summary cannot be avoided, but this unsystematic risk can be avoided with diversification. Avoided means we can reduce that from our portfolio. So we can call it as a controllable risk. If I want to divide it in controllable and non-controllable, unsystematic risk is a controllable risk, but this is non-controllable risk. You cannot control it. Okay. So these are basically the division of systematic and unsystematic. It can come for 4 marks for theory. This systematic risk is denoted by beta. So that's beta that we are talking about. Always, please understand, ladies and gentlemen, beta will always be calculated for a particular company as against the market. As against the market. So whenever you want to calculate beta, with uh, calculating beta between R and L company will not give you a proper answer. Obviously, mathematics is there, you can apply it on any figure no matter what the company is, but logically, the beta is always calculated for a company R as against the market. So, market beta is deemed to be 1 always. The market beta is assumed to be 1. Okay, and then you calculate the beta of R or any other company, which will represent how big your risk is, how your company is risky or less risky, we can say. If the beta of R limited goes beyond 1, your company is very risky. If it is below 1, it is less risky. So yeah, that is the answer of the concept of beta. Beta is a measure of systematic risk. Systematic risk is a market specific risk. Market risk is assumed to be 1, and the beta of the company is always calculated against the market. And if the beta is more than 1, it will be said that it is riskier than the entire market. If it is less than 1, it is less riskier than the entire market. In order to calculate the beta, understand, in order to calculate the beta of any company, we have to cover up the risk. We have to compare the risk of R limited with that of market. So let's go with the concept of correlation coefficient. Do you understand? Correlation coefficient was a concept where we used to calculate the relationship between two different stocks, let's say L and K. And beta will be a concept where you will be calculating a kind of a similar relationship between the stock and the market. The second item, the second person, or we can say the second particular, will always be market. Now, correlation coefficient was calculated like this: covariance divided by standard deviation of L, standard deviation of K. So covariance of LK. So that was covariance was the actual risk, and in the denominator we took a separate risk of L and K both. Okay, so in a sense I can easily say that the numerator is a variance and the denominator is also a variance, because the standard deviation is being multiplied twice at the same time, but it is of a different companies. Beta has a similar concept. Beta also considers covariance of stock with the market divided by standard deviation of M into standard deviation of M. Beta also consists of variance in the numerator and denominator. See, wherever we have seen at almost at all the points, whenever it comes to risk, we compare variance of a particular stock with that of the other. Now, in this case, when you calculate the beta of a stock against the market, you will have to take the covariance of the stock and the market, and then in the denominator you will have to take the variance. It's a covariance of market with market. So in the denominator we are showing the risk of the market, and in the numerator we are showing the risk of the stock. So let's say, for example, the risk of the market or variance of the market is 100 and the covariance of market and stock is 80, the beta will be 0.80. Again, it will be interpreted in the same manner we used to interpret the correlation coefficient. If the market's risk is 100 and the beta stock's risk is 80, the beta of the stock will come to 0.80. That means it is less riskier than the market, and it is obvious that we can clearly see the market's risk is higher than the stock's risk. So that's why the beta is coming to 0.80. Let's say, for example, another example. let's say for example, 100 is the covariance or standard deviation of m square variance of the market, and 120 is the covariance of the stock. The answer will be 1.2. What does that mean? That means that the stock is riskier than the entire market. So if the market moves up by 10%, please understand, if the market moves up by 10%, the stock will move up by 12%. 1.2 or 0.80, this 1.2 or 0.80 shows the movement of the stock against the market. The movement of the stock against the market. So market's return multiplied by beta will give you the stock's return theoretically. Again, another example. Let me take another example. I need to find the space. Let's say beta is equal to minus 120 divided by 100. At this point, the beta will be minus 1.2. And what does that mean? If the market's return is 10%, the stock's return will be minus 12%. 10 into 1.2 minus. So we can clearly see that when the beta is negative, and if the market is going up, stock will go down. If the market is going down, stock will go up. That means negative sign indicates the movement of the stock in opposite direction. Positive sign indicates the movement of the stock in same direction. Am I right? Negative, positive. Positive sign indicates the movement of the stock in the same direction as that of market. Negative sign indicates the movement in the opposite direction as that of market. Beta is a measure of systematic risk. It is represented like this. Yeah, correlation coefficient had this limit of -1, 0 or +1. I told you that the correlation coefficient cannot go beyond this limit, but beta doesn't have such limit. So beta can be -2, -3, 2 or 3 as well. So it can go up to any point. Beta doesn't have any limit. But the way of interpretation, the approach of interpretation of correlation coefficient and beta is same. Again, let me tell you one thing. Beta is nothing but a measure of the risk against the market. So risk of the stock against the market, that is covariance of stock with the market, divided by market's variance. This standard deviation of m square is nothing but the covariance of market with market. In another word, if you want to write down, you can write down like this: covariance of market with market. So basically what we are doing is we are putting the variance of the risk of the market in the denominator and risk of the stock in the numerator. And then covariance of mm is nothing but standard deviation of m square. Yeah, one more thing, please understand covariance of stock and market. Now you remember the formula of covariance of stock and market? We can change the formula to this: RSM standard deviation of S standard deviation of M. Do you remember the correlation coefficient formula is equal to covariance divided by these two standard deviation? If we take the denominator on the left hand side, covariance formula will become this: R correlation coefficient into standard deviation of S into standard deviation of M. Okay, let me just solve this on our register. So the basic formula that I started with was like this. Beta is equal to covariance of stock with market divided by covariance of market with market. Then covariance of stock with market divided by standard deviation of m square. Am I right? Covariance of market with market. Then covariance of SM. If you remember, correlation coefficients formula was like this. Covariance of SM divided by standard deviation of S, standard deviation of M. So we can take this entire part on the left hand side, and we will have a formula for covariance of SM is equal to RSM standard deviation of S standard deviation of M. So we can put it like this: RSM standard deviation of S standard deviation of M divided by standard deviation of M square. You can clearly see that one standard deviation of M from the numerator can be eliminated with the 1 in the denominator. So RSM standard deviation of S divided by standard deviation of M. That's it. The beta formula can be converted like this. So you should remember all this, because institute can just give you this much and these two figures. So you can easily calculate it. Obviously you can calculate this one also. Getting it? Okay. Let's move ahead to this calculation now. So that was one of the method of calculating beta, but beta has two different methods to calculate. For calculation, beta has two different methods. One is called as regression analysis. You have seen this formula in CA Foundation, and the another one is called as correlation analysis. The one formula that we have just discussed is covered under correlation analysis, and beta of the stock is equal to covariance of stock with market divided by market variance. In the denominator, we are taking the variance of the market only. In the numerator, we are taking the variance of the stock with the market. So we are basically connecting our stock with the market to understand the risk. The another method which will give the similar answer is regression analysis, which will have to thoda sa mug up. Standard deviation of xy minus n bar x bar y divided by summation, not standard deviation, summation of xy minus n bar x bar y divided by summation of y square minus n bar y square. Now understand the meaning of this. N is the number of observation given in the question. Okay, bar x is the stock whose beta is being calculated. Y is nothing but the market return, and bar x means the average return of x, bar y means the average return of y. Summation of xy means the return of x multiplied by the return of y for all the columns, then summation. Summation of y square means first square all the figures of the y column, market's return, and then total it. This is this expected return of market, then square of it, and then multiplied by n. We are going to solve this, and we are going to see how it comes into the practice. But most of the time this is the one which you will get it logically. In this question also, we are going to find out the beta coefficient of R limited with the same example of covariance of this correlation analysis. Now for that purpose, we need covariance of the stock and the market and market variance. See, market variance has already been calculated by us here, if you remember, right? And that was, let me just check. Can I say this figure? 42.18, it is the market variance, which was then put under square root to find out the square root of the market, standard deviation of the market. But we need covariance of the stock with the market. Now tell me how to calculate the covariance of the stock with the market. It's very simple, sir. RS minus bar RS, the deviation of the stock's return and the deviation of the market's return. Am I right? And then since probability is given in the question, you are going to multiply it with the probability and then summation. Am I right? Covariance. I told you the formula for that. So have a look. This is our column, R minus bar R. and this is the next column, m minus bar m. When you multiply it, you will get this figure, r minus bar r into m minus bar m. So this is 7.5, first figure. 2 into 3.75 minus 3 into 1 minus 1.25. So this is the figure, and then you just multiply it with the probability. You will get this column and then the total. This is the covariance, 37.5. Please understand, you don't have to divide this covariance by number of observation. The probability has done its work. So no more there is a need to divide it by n. Number of observation has not to be, should not be considered in the denominator. 37.50 itself is the covariance. Now you are going to calculate beta. 37.50 in the numerator and 42.188 in the denominator. I can clearly see that the market's variance is higher, 42, than the stocks variance, which is 37.50. Stocks variance with the market, 37.50, and the beta will be 0.888. What does this 0.888 means? First of all, positive beta, it means same direction. The movement of the stock will be in the same direction as that of the market. Then 0.88 less than 1, the beta is less than 1. That means less riskier than market. So if the market's return goes to 10%, stocks return will go to 10 into 0.888, that is 8.88%. This is how you calculate the stocks. So from now onwards, you will remember the formula of the beta also. Have a look. I will just go through all the formulas first. We have seen this formula of return, single security return, dividend plus capital appreciation divided by the initial investment. With probability return is summation of RI into PI. RI means the return and then multiplication of the probability. Okay. Portfolio return is the weighted average return. Easy. Fourth return, CAPM, we are yet to come on this point. So I'm just going to leave this. Then we understood the meaning of total risk. Total risk is equal to systematic risk plus unsystematic risk. Risk of the single security without probability is nothing but first calculating the deviation, then squaring it up to negative to remove the negativity, then total, and then divide by n, which will give us variance. Then you put a square root, which will give you the standard deviation. But in the same scenario, if the probability has been given, we calculate the deviation, then square it to remove the negativity, then multiply it with the probability, then summation will give you the variance, and then square root will give you the standard deviation. Okay. We also learned about how to calculate a portfolio risk with two securities or assets. So standard deviation of P square is weight of A summation of A square plus weight of B summation of B square plus 2 into weight of A weight of B summation of A summation of B RAB. This RAB is standard deviation of A summation of B. This much of the answer, please understand. This much of the figure can also be replaced with covariance of AB. Okay. When correlation coefficient is exactly 1, we call it as perfectly positively correlated, and then the formula will get reduced to this much. When it is -1, it is negatively correlated, the formula gets reduced to this much. Weight of A summation of A minus weight of A summation of B. When R is equal to 0, summation of P square is equal to weight of A summation of A square plus weight of B summation of B square, and then square root. Risk of the portfolio of 3 securities has to be calculated in the same manner as we have calculated for the risk of the portfolio of the 2 securities, that is A plus B plus C whole square. A square plus B square plus C square plus 2AB plus 2BC plus 2CA. With every A, B and C, you are going to put standard deviation of A, weight of A, summation of B, weight of B, summation of C, weight of C. And then with every 2AB, you are going to attach RAB at the end, RBC at the end, and RCA at the end. That's it. These are the formulas. Yeah. Then we discussed about the beta. Beta can be calculated using two methods. The first one is the regression analysis, where summation of xy minus n bar x bar y divided by summation of y square minus n bar y square, where y represents market return and x represents stocks return. We are going to see some questions on that. Don't worry about it. And then we learned about this formula of correlation analysis. Understand, beta of x is nothing but covariance of xy. Xy divided by summation of y square. Y means the market in this scenario. Y will always be market in this scenario. This covariance of xy can be written like this also. Correlation of xy divided into summation of x summation of y, and then one standard deviation of y from the numerator and one from the denominator can be eliminated, and we can reach to that formula. So there can be any of the formula that we will have to use. Let's discuss about the covariance. I told you the meaning of covariance. Covariance is nothing but standard deviation of a particular stock's square. But when you have to calculate a variance between two different securities, we can call it as Ri minus bar Ri square. So we can write it as Ri minus bar Ri, and then again Ri minus bar Ri. What you have to do ultimately is just replace this I with some other security, x with y. So when there is no probabilities given to you, you can use this formula, Rx minus bar Rx, deviation of the x multiplied by deviation of the y multiplied by probability if the probability is given, and then summation divided by n. Otherwise, this is the formula that we will learn later on. Okay, what else? Yeah, coefficient of correlation is very simple. Coefficient of correlation is the relation of the stocks variance stocks variance put together in a single portfolio and stocks variance, both the stocks standard deviation risk taken separately. So this is a risk without diversification or without making portfolio for x and y, and this is the risk of the x and y itself in a portfolio. So that's called as correlation coefficient. There is one more concept called as coefficient of determination, that is R square. Whatever is the correlation coefficient, let's say for example correlation coefficient is 0.80. When you do the square of that, 0.8 into equal to, the R square will come to 0.64. Okay, this 0.64 represents that 64% is the probability or reliance on the beta of the stock. It means that the market's return is being stock's return is being affected with the market 64% of the time. We'll look after it later on. Now this much we have learned till now, and we are going to see some questions on this. Now question number 16 is completed. Let's focus on question number 17. The distribution of return of security F and the market portfolio is given to you. You can clearly see, again this is a question, similar type of question, where one is the stocks return, another one is the market's return. Whenever you get a chance to specify a few things, make sure you do it. This is a market's return, market portfolio, and the probabilities are also given to you. You are required to calculate the expected return of security F. We can simply multiply it, the probability, with the return, and then do the total of it to calculate the expected return. We can do the same for the market portfolio as well. Okay, then they are asking us to find out the covariance. Can we calculate the covariance? It's very simple, sir. F minus bar F deviation, P minus bar P deviation multiplied by probability, and then summation. This will give you the covariance between the market portfolio and security, and later on they have asked us to calculate the beta of the security. See, beta of the securities formula is very simple. Covariance of the stock with the market, which has just been calculated by us, divided by market's variance, which is standard deviation of P square. See, this is the column that you have calculated, deviation of the market's return. You do the square of it to remove the negativity, multiply it with the probability, and do the summation. This will give you variance of the market, and that is what is required here. So this is all about the calculation part now, which has been left. See, we multiplied with the expected return. This is the expected return 17. So 13 minus 17. This is the deviation. Okay, this is the deviation of F, right? And I don't think so we need anything else. We don't need these columns for by now. This is not required as such. So deviation of F is enough. Now market portfolio, these are the returns, these are the probabilities. You multiply the return with the probability to get the expected return, which is 14. So minus 10. Now we will calculate the deviation. Minus 10 minus 14. This is the deviation of the market's return, expected return from the exact return. So 24 is the deviation, 24% minus. Then 20 minus 14, 6, 30 minus 14, 16. So this is the deviation. You have reached at the deviation, right? Then what you are going to do? You are going to do the square of the deviation. Then multiply it with the probability. Do the total of it, 264. That's it. We have the deviation. Yeah. Okay. Then what we are going to do? See, they have followed a different approach. We can also follow a different approach. See, this is the deviation. No, they have also followed the same approach. In fact, deviation of F means this column. Then the deviation of market means this column. And then the probability. These three columns, when multiplied, will give you covariance. So you have the figures with you. Covariance is coming to minus 168 and the variance of the market is coming to 264. That means there is an opposite direction movement. The beta will be 168 divided by 264. That's minus 0.636. So please improve one thing here. The negative sign has to be included. That's a printing mistake. Negative sign, please make sure you put a negative sign there. Okay. It was pretty easy to calculate the covariance, I suppose. Beta. Once you understand the logic, it becomes easy. Now, this is a question where we are going to, I think, use regression analysis. No, they have again used the covariance analysis for the same. Given below is the information of market rates of return and the data from the two companies. Now, market and the two companies are given. So, you are required to determine the beta coefficient of A and B. So, whenever you have been asked to calculate the beta of a particular company, you should always calculate the beta with the market return. So, first take the returns of market and company A, then take the returns of market and company B and apply all the procedures. See, beta is equal to covariance of, let's say, AM. A is the company, M is the market, divided by standard deviation of M square. Right? You don't have to remember the formula. Just take the variance of the market in the denominator, risk of the market in the denominator, as against the risk of the stock against the market. See, if you want to remember the formula of beta, please understand the logic of that. Beta shows the risk of the stock as compared to the risk of the market. So obviously the market's risk has to come in the denominator. Also, standard deviation comes from a variance, and variance is the main measure of risk. Maximum point of time, at maximum situations, we take the variance into calculation. So risk means the variance. Market's risk is the standard deviation of M square, and the stock's risk is the covariance of the stock with the market. Don't take standard deviation of A square. Don't take the variance of A square. This is independent variance. This is not against the market. We want to find out the variance of the stock with the market. That is in the numerator. So the entire market's risk is here. Stock's risk with the market is in the numerator. That is variance. So numerator is also variance. Denominator is also variance. Understood? Now, standard deviation of M square, it's very easy to calculate the standard deviation of M square. What you are going to do? There is no probability in the question. So first of all, you will have to calculate bar M, which is nothing but total of all the 3 years, 15, 16, 17, and then divide by 3. Then you calculate the deviation, summation divided by 3. Then you calculate M minus bar M. Then you do the square. Then you do the summation and then divide by N. This will give you the variance. And covariance is also easy. You calculate the bar A, then calculate the deviations, and then you will have to multiply. See, I will just start with company A, and company B will be your homework. So these are the returns. These are the market's return. A, M. Okay. This is the deviation of A minus bar A. See, 34.3 is the total, divided by 3 will give you 11.43. So 13 minus 11.43 is 1.57 deviation. 11.5 minus 11.43 will give you 0.07. 13 minus 11.43. 11.5 minus 11.43. And 9.8 minus 11.43. This is how it has been calculated. Okay, this is just a standard, we can say this is just a deviation of the stock A. Now we are going to calculate the deviation of market also. 12 minus 10.67, 11 minus 10.67, 9 minus 10.67. We have the deviation of both. Now then do the product of these two. Deviation of RA divided by into deviation of this. The total of the deviation is 4.83. Covariance 4.83 divided by 3. Why divided by 3? Because the probability is not given in the question. That's why we will have to divide it by 3. So the covariance comes to 1.61. And the beta is very easy. Beta is nothing but covariance divided by standard deviation of m square, and standard deviation of m square is this column. How did we calculate the standard deviation of m square? Please understand, ladies and gentlemen, this m minus bar m, this is the deviation of the market's return. Square this figure and you will get this one. Do the total 4.67, then 4.67 divided by 3 will give you the variance. So this is the covariance, and this is the market's variance, and this is the beta. Simple, same, everything is same. Nothing's new in this to learn about. You will do the same with company B. You will have to take market return and the B's return, and you apply the same procedure. Question number 19 in front of you. Yeah. And in this question we are going to use a different method of calculation of the beta. Question number 19, have a look. The following information is available with respect to JK Limited. The previous 3 questions, just a second, I am just interrupting this question. The previous 3 questions that we have seen, I think 3 or 2? Yeah, almost 3. All the 3 questions, first of all, 16, 17 and 18. Yeah, previous 3 questions, all the 3 questions asked us to calculate the beta, and we used the correlation analysis method. Go with that method all the time. It may take some time to calculate, but this is conceptual way of finding out the beta. First. Second, whenever the probabilities are given in the question, make sure you are using only correlation analysis method, not the regression analysis. And in this question you will see there are no probabilities given to you. So at that time what can happen? You can use the correlation analysis also, regression analysis also. The following information with respect to JK Limited is given to you. JK Limited. This is JK Limited's information, and this is market's information, and this is risk-free rate of return on government bonds. From 2002 to 2005, the market prices are given to you, dividend per share is also given to you. Same with the market index and the dividend yield, and then the return, risk-free rate of return, government bond. Compute the beta value of the company as at the end of 2005. Now we have to compute the beta value. For the beta, please understand, we need 2 things: return of JK Limited and return of market. Without that we cannot calculate the beta. Okay, beta can be calculated with 2 different methods: regression analysis and correlation analysis. If you go with regression analysis, it is going to be like this: summation of JM. Why J? J is the JK Limited's return, M is the market's return, minus N bar J bar M, average return of both, divided by summation of M square minus N bar M square. Okay, and if we go with the correlation analysis, it will be covariance of Jm divided by standard deviation of M square, means variance of M. Okay, now in this question they have followed this approach. You can do this one also. Since we have been using the correlation analysis from the past 3 questions, we will shift to this one. Now understand what you need. First of all, you need the returns of both the stocks, J and the market. Let's find out that one. Now return of J Limited can be calculated with the method of dividend plus capital appreciation divided by initial investment. Why? Because the dividend per share is given to you, and we can calculate the capital appreciation by leaving this year. We have to skip the first year. You remember one of the questions in the beginning where we skipped the first year because we wanted to take this one as P0 and P1 then. So at that time we will have only 3 years to evaluate the returns for 2002, 3, 3, 4 and 4, 5. Okay. So we can calculate the capital appreciation now. 279 minus 242. 279 minus 242. That's 37 rupees of the capital appreciation. Right? Then 305 minus 242. 63. And 322 minus 305. 17. So this is our capital appreciation. This is going to be dividend per share. You will have to ignore the first dividend per share as we are not calculating any answer for that year. So we have the capital appreciation, we have the dividend per share as well. What you can do is you can just do the total of both and then divide it by the respective market prices at the start of the year. So 37 plus 25 goes to 62. This is 93 and 35 plus 17 goes to 52. Please understand, this is the total return. Now 62 divided by 242, the opening price, not the same 279, will give you the return for 2002-3. That will be the first return. Then 93 divided by 279, 52 divided by 305 will give you the returns. I hope they have calculated it very well here. See, 242, 279, 305, 242, 279, 305. This is the dividend, 25, 30, 35. See, you can clearly see 25, 30, 35. They have skipped the first dividend, and then in the bracket you can see capital appreciation, 279 minus 242. So these are the 3 different returns that you have calculated. You have to do the same thing with the market, but with the market the yield in percentage is already given to you. So what you have to do is the return of the market is nothing but the capital appreciation in percentage plus dividend yield in percentage. That's it. If one figure is already given in the percentage, calculate the second one in percentage itself. So what you can do, you will skip the first year. Then calculate the capital appreciation. 1950 minus 1812. That's 138. But don't stop here. 138 divided by 1812 will give you the capital appreciation yield. Okay. 2258 minus 1950. 308. 2220 minus 2258, that's minus 38. Now divide this capital appreciation or loss with the previous year's figure to get the yield. See, 1812, 1950, 2258. Right. So this is the percentage of index appreciation, that is capital appreciation. This is the percentage of yield. You just add both of them and you will get the market's return. That's it. This is where you have reached at a point where you have the 3 returns of the stock and 3 returns of the market. Okay. You have R and M both. J and M. See, this is J and this is M. These are the 3 returns of stock. These are the 3 returns of the market for these 3 years. What is that we are going to do first? This is the formula, summation of xy minus n bar x bar y divided by summation of y square minus n bar y square. So step by step, the first thing, x into y. First of all, we will multiply these figures. We will reach at this one, xy, and then we will do the total of this, summation of xy. This summation of xy comes to 851.36. Okay. After that, n is the number of observation, which will be 3. Bar x bar y. How to calculate the bar x? Since there is no probability, total all these 3 figures, total of all these 3 figures, and then you will get 20.91 as the bar x. Similarly for bar y, means the market, n bar x bar y. Then this column of y, you just have to square it to reach at y square 12.62 into 12.62 159, 21.79 into 21.79 474. In that manner you will get the y square and then total it. Ny square 3 into bar y 13.24, 3 into 13.24. See, this regression analysis is something which is more of a calculation and mathematical part rather than under conceptual part, so that I will explain, so that I can explain anything. No, there is nothing like that once we get to know the process. So in this thing, if you calculate the regression, if you calculate the beta using regression analysis, you will have to follow some procedure where the calculations are involved. So practice is the main concern here in this case. With this we end the concept or the discussion for the beta. But that doesn't mean that beta will not be used in the coming questions. There will be lots of questions where we are going to use the beta. In this question, the beta of 0.15 has been reached. That what does that mean? You should be able to interpret it. It means that if the market's return goes to 10% above, the stock's return will be 0.15 times. That means 1.5% above. The change in the market if the change in market is 10%, the change in the stock will be 1.5%. Let me tell you one more thing. If this is the formula for the change in the stock, I can calculate the beta as like this. Beta is equal to change in the return of market, stock. Or instead I will just derive the formula. Let me just show you. Change in the return for stock is equal to change in the return for market into beta. Am I right? This is how we calculate it, like 10 into 0.15, that means 1.5%. Am I right? Then take that change in RM on the left hand side. So our formula will be beta is equal to change in the stock's return divided by change in the market's return. We are going to use that formula in the coming question. So please remember this. This is another way of calculating. If the change in both the stocks and market is given to you, then you can calculate the beta like that. Okay, let's end our discussion and open the charts. So this is the chart for portfolio management. We start with the investor requiring to invest in the market. At that time, there are two important factors for him to consider before investing or putting his money in the market. What is the return of that particular investment and risk of that investment? Let's talk about the return. We have discussed about the single security return without probability, which is return is equal to dividend plus capital appreciation divided by initial investment. With probability, it is nothing but RI into PI. When we discuss about the portfolio return, it is nothing but the weighted average return. Okay. Then comes this point, capital asset pricing model. Now we are going to extend the definition of return, required return in an investment with the concept of capital asset pricing model. We have skipped a couple of questions, I think, in the past related to capital asset pricing model because of the capital asset pricing model. So after completion of this concept, I think we can shift to those questions. And if those questions are very easy, I will just put it for your homework. Okay, but before moving forward, we also saw some formulas for the risk. If you remember, single security Markowitz model, or you can say modern portfolio theory, without probability divided by n, with probability multiplied by probability. Portfolio risk for 2 securities has been taken over by us like this. Portfolio risk for 3 securities is also considered. Then we also divided the risk, the total risk, into two parts: systematic risk and unsystematic risk. Unsystematic risk can be diversified and reduced. Systematic risk can be calculated for the single asset and the portfolio as well. That we will look later on. Single security or asset beta is calculated using these formulas: regression analysis or correlation analysis. So correlation analysis basic formula is this: covariance of xy divided by summation of y square. Getting it? And then the regression analysis is this formula. Okay, now I will take the break, and in the next lecture we are going to discuss about capital asset pricing model concept. Bye bye. So welcome back after the break, and now we are going to start with the new concept, that is capital asset pricing model. So let's have first look on what are the types of questions and the concepts that we have already completed. We have completed with the expected return of the single security and the standard deviation, portfolio return and the portfolio risk. Then it was correlation analysis. correlation coefficient, covariance, and then beta of the single asset in regression analysis, correlation analysis. So all these concepts have been completed. In fact, risk of the single asset, two asset portfolio and three asset portfolio has also been completed. If you look at the concept sheet, these are the 4 questions: 16, 17, 18, 19 that has been completed recently. That was all on the beta, and now we are going to continue. We are going to discuss about question number 20 onwards concepts, that is capital asset pricing model. And you will see after this capital asset pricing model discussion, there are lots of questions that we are going to continue before discussing a new question. And in fact, in the beginning, I think I'm going to skip this 20, 21, 22, 23 because these are very small questions only for the purpose of concept, not at all for the purpose of exam. Okay, but that I will inform you later. And then we'll start solving the questions, and you will see every name here, every concept here will be familiar to you: CAPM, beta, and dividend and earning growth model, two-stage dividend discount model, Gordon's growth model, portfolio return, and so on. So lots of concepts will be familiar in this sequence, and we are going to continue with lots of questions like question number up to question number 60 and 61. Yeah, we are going to continue with question number 61, and then our major concept will be there related to arbitrage pricing theory. So practically speaking, I will tell you, if I divide the entire chapter, I can divide it into first 60 question and rest of the 35 questions. Rest of the 35 questions will be of next level, we can say. Not that difficult, even those will be easy, but yeah, big questions or different types of concepts will be covered from 62 to 95. Got it? In fact, not even 95. In the last I think there will be, yeah, 95 we can consider. So we will look at the questions very in deep from 62 onwards, but till that time we are going to move on very fast. Okay, let's first come to the concept. The name of the concept is capital asset pricing model, that is CAPM. This is a theory called as capital asset pricing model. Now let me just brief you about the returns. Let's say this is return and this is beta, means risk that we are considering. Okay, let's take the easiest concept, that is FD, fixed deposit. Do you think there is any risk in that fixed deposit? There is always a risk in every kind of an investment. Okay, but virtually fixed deposit or savings or government bonds, such are the instruments which carry zero risk virtually. Okay, so let's say that if you have money, you can invest that. The very first option that you have is to invest in the fixed deposit. What we can call it as the risk-free rate. YRF, risk-free investment. It can be anything. It can be anything like FD, bonds, Government of India bonds, and treasury bill. These are the risk-free securities where you can invest your money and it will be secured. Okay, secured means there will be zero risk in that. So let's say, for example, if you want to invest, if you have the money and you want to invest in risk-free securities, the return that you will receive will be 4% with virtually 0%, zero risk. Okay, we will denote the risk in terms of beta and not standard deviation here, and I will tell you the reason of that also later on. Okay. Now, if I want you to invest from shift your investment from the risk-free securities to little risky securities, and I request you to come to the share market. Then tell me one thing. Let's denote the returns of the market as RM. And tell me one thing. I will also give you 4% here in the share market. Will you come in the market and invest your money? No. First of all, you will never invest in the share market with 4% of the return. Why? Because you are getting the same level of return. Understand that, remember that question. You are getting the same level of return in the risk-free securities with zero risk. Then why would you invest in the share market for the same level of return and higher risk? Beta of the market, that is the risk of the market, is said to be 1, right? Deemed as 1. Okay, so will you invest in the share market? No, sir. I have to anyhow somehow give you more return than the risk free securities, and then only it is possible for you to think about investing in the share market. So let's make it 5%, sir. Will you still invest in the share market? Maybe there will be couple of like out of 10 there will be one person or two maximum who will think about it, but still maximum population will not invest in the share market because the extra return that you are getting is not justifying the risk that you are going to take. The risk is shifting from 0 to 1 and the return is shifting only by 1%. I don't think so that is justifiable. For just 1% of the return, I'm not going to take that much of the risk. All the investors will have the same opinion. Okay. For that purpose, I think we should increase the return of the market to such a level where shifting from 0 to 1 is justifiable. Let's make it 15%. Now I think it is attractive return. And now I think it is attractive return. You have 1 lakh rupees with you. You can keep it invested without any risk in risk-free securities for the entire year, and that 1 lakh will only become 1 lakh 4,000. But you can choose to take the risk, and that 1 lakh rupees can become 1 lakh 15,000 at the end of the year. So there is a pretty 9,000 rupees of the difference between the returns that you are going to earn. So yeah, lots of people will decide to invest in the market. So the demand for the market investment and the risk-free investment will also be there. There will still be people who don't want to take the risk and still will go with the risk-free security. But yes, we can say that 9% of 11% of the difference. 9,000, no, it was not 9,000. I think it is 11,000 rupees of the difference that was there. Okay, so 11% is the extra return that you are earning for the extra risk of 0 to 1, that is 1. Okay, that's cool. Now I'm going to request you to come in the share market and invest in some company, let's say Tata Motors. And the Tata Motors will also give you 15% return. And the risk, when you calculated the beta of the Tata Motors, it came to 1.2. Now tell me, are you still going to invest in, will you still prefer to invest in Tata Motors? The answer is no. No one will invest in Tata Motors because that question, the concept that we learned in that question, the previous question where we had to select only 3 securities. The same logic will apply here. If I'm going to get the same level of return, why I will take higher risk by investing in Tata Motors? 15% of the return is received in this market as well, means the share market as a whole at only 1 risk. Then why I'm going to take 1.2 risk? So the question here is, if we want to convince the investors to invest from or to shift from share market to Tata Motors, then we have to make sure that the increase in the risk is justified by the increase in the return. Are you getting it? So the return has to be increased because the risk is 1.2 fix. So return should be increased. My question is, what should be the return here? That is what is capital asset pricing model. Capital asset pricing model will give you a logical formula to calculate the required return in Tata Motors shares. And what is that? It's very simple, sir. See, when you shifted from risk-free security to risky securities, you received a premium of 11%, and for 1 unit of risk, 1 minus 0 is 1. So entirely you took 1 unit of risk and the extra return that you received was 11%. So can I say that the return that you received for 1 unit of risk is 11% only? Yes. This 15% is not the return for 1 unit of risk, because out of that 15, 4% you are 4% is the return you are earning easily without any risk. So we can include that 4% in here, and we can say that the risk that we are taking will give you 11% of the extra return. Now the question is, if you are getting 11% of the premium, we can say that it is a premium. It is a premium that you are getting over 4%. So for 1 unit of risk, if 11% is the premium, then how much is the premium for 1.2 unit of risks? Right? Am I right? So let's start with that. 11% for 1, then how much for 1.2? Let's do the cross multiplication. 11 multiplied by 1.2. So the extra return that we need is 11 multiplied by 1.2. Am I right? It will be 1.2 multiplied by 11. This is just the extra return. Just a second. So that comes to 13.2. This is just the extra return. 11% is not the final return, over and above which we got the premium over 4%. Over 4%. This 11% was over 4%. So this 13.2 will also be over 4%. So the answer will be like this. 4% is the return that I should receive for zero risk, and 13.2% is the return that I should receive for 1.2 unit of risk. Am I right? So the total return that you want is 17.2%. So 17.2% is the return that you need if you want others to convince you to invest in Tata Motors. That means if you choose to invest in Tata Motors, the required rate of return is 17.2%, and that is calculated as like this. And it's very simple, sir. 4% was the risk-free rate of return, and this is what you need bare minimum because of the zero risk. And now from this point, how much risk you are taking? 1.2 unit. So you can clearly say that for 1 unit of risk, 11% is the premium. Then for 1.2 unit of risk, how much is the premium? 13.2. And this is calculated as follows. Let's make a formula out of it. 4 is nothing but the risk-free rate of return, plus 13.2. We calculated 13.2 with this 1.2 into 11. 1.2 was beta. And how did you calculate 11? 11 is nothing but the market rate of return minus risk-free rate of return. So it is nothing but market rate of return minus risk-free rate of return. So I'm putting the figures here. 4 plus 1.2 in bracket 15 minus 11. Sorry, 4. Now we need to understand each and everything out of this. This 4 is the return for zero risk. Right? This is for zero risk, and the premium for the risk. For the risk that we are taking, this much only is the premium that we should receive. Okay. Now, this 11% is called as the premium, but that is not the premium for our share. This is the premium for investing in the market. It will be called as market risk premium. Got it? But then this market risk premium, when multiplied with the beta, this entire figure is called as, this entire figure will be called as security risk premium, which comes to 13.2%, and this was 11%. Understood the concept of CAPM? This is called as capital asset pricing model, calculating RI. RI means the required rate of return of the investor. If you want an investor to invest in the security which has a beta of 1.2, then you will have to give them this much return, that is 17.2 is the minimum return that you should give them, and this will justify the risk that has to be taken. 15 minus 4 will give you the premium just to invest in the market, and then this market premium, when multiplied with the market's beta, securities beta, it will give you the risk premium that you should earn for taking this much of the return in this security, this much of the risk in this security, and 4 was the minimum. See, wherever you go, this 4 will always be there, because this is the return that you are earning without taking any risk. And from that point onwards, there will always be something in the risk, na? Something in the risk. So that is the premium. This entire part is the return for the risk that you are taking. This is the return without for zero risk. This is the return for risk, and this is the formula for capital asset pricing model. Okay, we have learned this formula. Let's come over to the question now. Okay, before that, I think we should go through the charts and understand the CAPM. Return of the security I is calculated as the risk-free rate of return plus beta of the security I in bracket RM minus RF. RM is the market rate of return and RF is the risk-free rate of return. So this includes the premium of the premium for investing in the market. When multiplied with the beta, it includes premium for investing in the security, and then this RF. If you calculate a return for the portfolio according to CAPM, then you just have to make sure that the beta that you are considering in the formula should also be of portfolio. That's it. The only difference is this much. If this R is for I, the beta should also be for I. If this R is for P, the beta should be for P. Right? Okay. Now let's solve some questions. Question number 20, homework. You can do it by yourself. Question number 21 is also homework. 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 Do it after certain questions, like after we complete some questions. Homework covered in study material. Question number 23 is the smaller version of question number 24, and this is what I'm considering in this lecture now. So we'll start directly from question number 24. Have a look. See, the returns and beta of 3 stocks are given below. Stock ABC, the actual return 18, 11 and 15%. Okay, this is actual return. I will tell you why. The beta is also given to you. We can clearly see that security A is very risky because the beta is highest. The risk-free rate of return is 9% given, and the market portfolio return is 14%. Which of the above stocks are over, under or correctly valued in the market? And what shall be the strategy? If it is overvalued, the strategy will be sell. If it is undervalued, the strategy will be buy. And if it is correctly valued, the strategy will be hold the share. So the strategy is not that important. So finding out the answer for the strategy is not that difficult. The answer is how to find out with the percentages that the stock is over, under or correctly valued. Now, I will tell you how to do that. Before taking over the question, I just want to take a couple of examples. See, this is the actual market price. Let's say today the market price is 100 rupees. Pay very careful attention to this point, okay? 100 rupees is the market price. Tomorrow it goes to 110. So if we calculate the return, it will be 10 divided by 100. 10 rupees is the difference between these two, and 100 is equal to 10%, right? Now, if we take the actual market price to 90 rupees and keep the last price constant. Why we are keeping this price constant? Because we want to find out whether the shares are undervalued or overvalued today. So we are changing the today's price and keeping everything else constant. Okay. But now if we keep the actual market price to 90, you will realize that the return has increased from 10 to 20, right? 90 and 110 difference divided by 90. So you can clearly see your return now is 18.18%. Now tell me one thing, looking at the actual market prices, which share or in which case the share seems to be undervalued? In this case, the share seems to be undervalued. So have you realized one thing? When the share is undervalued, the return is higher. Because when the share is undervalued, you buy the share at cheaper price and you increase your return. That's why the return will be higher. So whenever you see, now I will tell you. Now I am asking you another question. Looking at the returns, tell me which share is undervalued. Now you should remember always that the return with a higher percentage will be undervalued. Why? Because, tell me, return is higher because we might have purchased the share at a lower price, at a cheaper price, or at a lower price, and that's why it is undervalued. Lots of students makes this mistake. They are so we can say this, they get so confused that they think that 110 and 90, so this is overvalued. 18 and 10, so this is overvalued. Over doesn't mean higher number. Overvalued in terms of share price. This is what is important. Whenever they ask you overvalued or undervalued, they want to ask you about the share price and not the return. So whenever the share price is undervalued, the returns are higher. Lots of students are like, over means higher value, 110 higher, 18 higher. This is in percentage, my brother, and this higher percentage means the share price is lower, and that's why you are earning more, na? Getting it? So always remember, higher percentage doesn't mean overvalued. A lower percentage in return means undervalued, and a higher percentage sorry for the mistake, a higher percentage in return means undervalued, and a lower percent itself means, please evaluate why the return is lower here, because you might have purchased that security at a higher price, and costlier or a higher price itself means overvalued. Got it? This much. So undervalued or overvalued from this angle, or undervalued overvalued from this angle, should be clear from the next point. Now let's move on to the question. See, so now the question is asking us whether the shares are over, under, or correctly valued, and for that purpose we will have to find out the return in the market is higher or lower. The actual return is given to you. What should have been the return in the market should be calculated using capital asset pricing model. So what we are going to do, in every scenario we are going to put a capital asset pricing model, and we will find out the theoretical required rate of return. Okay. So let's do that. In A, what is, let's say for R, we are going to do it here. For this RA, risk free, what is the formula? First of all, let's write down the formula. That return is nothing but RF plus beta in bracket market return minus risk free return. This is the first portion, says the return for the risk free, for without the risk, and this is the premium for taking the risk. Let's calculate for RA. The risk-free rate of return is 9, beta is 1.7, market rate of return is 14, risk-free rate of return 9. Am I right? So 14 minus 9 into 1.7 plus 9, that's 17.5%. Let's do it for our B. Same. The beta will only change in the formula. 14 minus 9. 12. And the last one RC, 9 plus 1.2, 14 minus 9, 15. Now, these are the required return. Understand. These are the required return. At least this much of the return is required. Okay. Now, 17.5, 12 and 15%. This is the required return and this is the actual return given in the question. Now, let's look at security A. Your actual return is higher. Actual return is higher than required return. Why? See, I will just write something about it here. Actual return in this case is higher. Higher return means security is purchased at lower than required price. Am I right? The return will only be higher if you purchase the security at a lower price. And this lower price itself means undervalued. Shares are undervalued. It's very simple. Let's say, for example, again, I will just explain you this. The same situation I will explain you with my own figures because the figures are not given in the question. Let's have a look. Let's say you have purchased the shares. Let's say you are expecting that the share should cost you 100 rupees and at the end it will be 117.5, and that's how you have calculated 17.5 rupees of the gain on 100 rupees, and that's why you are saying that the return is 17.5%. This is the required return. Am I right? But the actual return, now let's do the reverse calculation, is 18%. Okay, let's keep everything else same, 117.5. Now you tell me, you have to do it on the calculator. 117.5 should be the price inclusive of 18% return. So all you need to do is 117.5 divided by 118%, because 18% is included in that, to arrive at the actual price. So 117.5 divided by 118%. The actual price that at which you purchased the share is 99.58. When you purchase the share at 99.58, the return will be 17.92 on 99.58 and it will come to 18%. Now you tell me, actual return is 18. Actual price is this. If only this is the price, the return will be 18%, and we can clearly see that this price is lower than 100. This is your theoretical market price. This is your actual market price. Now you tell me whether the share is undervalued or not. Yes, sir, it is undervalued. If the share is undervalued, the return will be higher. And if the return is higher, the share might have purchased at a lower price than required. This was the required price at this return. This was the expected price at this required return. And that's when. Understood the concept? In the similar way, we are going to look at the B part. You can clearly see that the required return is 12% and you are only getting 11%. Actual return is lower. Actual return is lower. Why the return is less? Because share is purchased at higher price. Whenever you buy a share at a costlier or anything at a higher price, the returns will be lower. And because the shares are purchased at a higher price, it will be called as overvalued. Am I right? So if the shares are overvalued, sell it. If it is correctly valued, hold it, buy it, right? 15% correct valuation, hold it. So this is how we have to solve such type of question. I hope you understood it. Let's move on to the next question. Calculate the market sensitivity index and the expected. What is market sensitivity index, man? Market sensitivity index. Sensitivity itself means risk. Market risk, it is talking about beta. Sir, how will we understand in exam this is why you are learning in front of me right now, sitting there under practicing the question. Unless and until you practice the question, you will not read it. Market sensitivity index, I will not guide you about it is beta, and only then when this is going to happen, the discussion that is happening between us right now, then only you will be able to go in exam and understand, na? Remember the formula then. Okay. Calculate the market sensitivity index. It means indirectly they are asking you about the beta and the expected return on the investment from the following data. So what has been given to us? What is the formula for beta? It is nothing but covariance of the security with market divided by standard deviation of market square. That means variance of the market, risk of the market in the denominator in terms of variance, and risk of the stock with the market in terms of covariance in the numerator. Okay. And RI. There are multiple ways to calculate the RI. Okay, single security dividend plus capital appreciation divided by initial investment. But tell me one thing, whether dividend is given here, no. Capital appreciation, no. So then that formula is not applicable. Multiple return into probabilities, multiply with the returns into probabilities, given here, no. Then that formula is not applicable to you. Now the third formula that you have is RF plus beta in bracket market return minus RF. It all depends upon the data given in the question, which type of formula will be applicable. So every time you have been asked to calculate something, please read the question entirely and then find out how you can use this data. What was the formula to use this data? When you go from backwards, then you start recollecting all the concepts. Okay, standard deviation of the asset, standard deviation of I, market standard deviation of M, risk-free rate of return RF, then expected return on the market RM, correlation coefficient of portfolio R, why portfolio? Let's take RIM. Since correlation coefficient is given, now what they did is with the formula of beta, covariance of SM or IM we can say, divided by standard deviation of M square. Then they replaced it with the correlation RIM, standard deviation of I, standard deviation of M divided by standard deviation of M square. Now one from the numerator and one from the denominator can be eliminated. RIM, standard deviation of I divided by standard deviation of M, and this is the formula. Put down the figures, you will get the value. The beta is coming to 1. Okay. Since the beta is 1, if the beta is 1, the market return and the security return will also be same. That is 15%. Have a look. When you will calculate the return, you will put 1 in this formula now. So 15 minus 13 plus 13. You will get 15 only. So understand the logic. 1, if the beta is 1, see, if the beta is 1 means it is equal to the beta of the market. If the beta of the market and the beta of the stock is same, then the return of the market and the return of the stock will also be same. That's 15%. You don't have to use this formula also in this question when the beta has been when you have already calculated the beta as 1, because it is 1. You can clearly write down that the return of the portfolio will be 15%, which will be equal to market portfolio. Whenever you remember this, whenever the beta is 1, RM and RP or RI is same. Okay, let's come on to question number 26. This is also similar question. The following information is available in respect of the security A. Equilibrium return, this is the return of the stock. Market return, this is again the return of the market. Now you understand, the return of the stock and the market return is same. That means the beta of the stock will be 1. That is what we have learned in the previous question. When the beta is 1, the market return and the security return are same. When the market return and the security return are same, the beta will be 1. The beta will be 1. Okay. 6% treasury bond trading at 120 rupees. This represent risk-free security. Now there is a trick in this question. So stay with me till the end of this question. I will tell you about that. Covariance of the market return. Covariance of security I with market is 196. Correlation coefficient 0.80 RIM. Now, what has been asked to you? What has been asked to calculate? Standard deviation of market return and standard deviation of security return. And it's very easy, I will tell you. See, calculating the standard deviation was like that: Ri minus bar Ri, then square, then probability, then summation or divided by n. But no such data in this question has been given to us. But you can, just a second. But you can clearly understand that. You can clearly understand that some data is given from which indirectly, directly you can calculate the standard deviation. So, first of all, let's make the beta as 1. Since the beta is 1 and the formula for beta is covariance of IM divided by standard deviation of m square, we can easily calculate 1 is equal to 196 divided by standard deviation of m square, and standard deviation of m is equal to 14. That's the market standard deviation. Put a square root on 196 and you will get the answer. So market standard deviation is 14. Now use the formula of correlation coefficient. Where do you think the standard deviation will come now? In which formula the standard deviation will come? This coefficient of correlation. So RIM into standard deviation of I, standard deviation of m is equal to covariance of IM. Am I right? Correlation coefficient is 0.80. This is what we have to find out. Standard deviation of m is 14 and this is 196. You can easily calculate it now. 14 into 0.8 and then transfer it to that side. 11.2. 196 divided by 11.2. So standard deviation of I will be your this much figure. 14 into 0.8, 11.2, 196, 11.2. That's 17.5%. That's it. So this is beta. This is standard deviation of market and this is standard deviation of the security. Easy, very easy, sir. Have a look on this question now. Mr. X is having 1 lakh rupees shares of Messrs. Kanyaka Limited. The beta of the company is 1.40. Okay, 1 lakh shares of Kanyaka Limited. Mr. Y, a financial advisor, has suggested having the following portfolio. So Mr. Y suggested Mr. X that you should invest in such portfolio: security SKPD, beta and percentage holding. Since the percentage holding has come to this question, let me tell you one thing. It's very easy to calculate security of individuals. Beta of individual security. Let me repeat it again. It's very easy to calculate the beta of individual security. No, sir, it's not that easy. So let me tell you one thing. How to calculate the beta of individual security? It is through two different methods: regression analysis and correlation analysis. It was summation of xy minus n bar x bar y divided by summation of y square minus n bar y square. You will have to practice it lots of time. And covariance of xy divided by some standard deviation of y square. That was the correlation analysis. But when you create a portfolio with multiple securities and you have already calculated the beta of the securities, my question is, what is the portfolio beta? And It's very easy. Portfolio beta is just like calculating portfolio return. It is nothing but the weighted average. How do you calculate the portfolio return? Sir, summation of weight I Ri. In the same manner, summation of weight I beta I. Portfolio beta will be there. Okay. Market return and risk-free rates of return are given to you. You are required to calculate the following for the present investment and suggested portfolio. See, this is the present investment, Mr. X, which is having X lakh 1 lakh rupees of the share, and the beta of that company is 1.4. So let's first calculate the return of Messrs. Kanyaka Limited. I think 12, 8. What is the difference between 12 and 8? Market return is 12, risk-free rate of return is 8%. The difference is 4%. What do you call it? Market risk premium. So if we go with the Kanyaka Limited, it will be RF means 4%. No, 8%. 8% into, not into, plus 1.4 into 4% is the premium. So what will be the answer? 13.6% is the return, required return, CAPM return for Messrs. Kanyaka. Now what is the return for the portfolio? What is the return for the portfolio? It's very simple, sir. Portfolio return is nothing but RF plus beta of the portfolio in bracket RM minus RF. We already have the beta, RF and RM, but we do not have the beta of the portfolio. So first we will have to calculate the beta of the portfolio, and that's very easy. You just take a table or column here and keep multiplying these beta with the weights. It will be 0.12, this will be 0.075, this will be 0.12, this will be 0.7, and then do the total of it. So the portfolio beta comes to 1.015. Put this 1.015 into 4. So the portfolio return will be 12.06. So we have two returns, one for the portfolio and one for the Kanyaka Limited according to their risk. And you can clearly see that the risk of Kanyaka is higher, 1.4, than the risk of the portfolio, 1.015, and that's why we are demanding higher return in Kanyaka, 13.60, as compared to 12.06. These two returns are the required return. If I want to convince any investor in to invest in the portfolio, the return of the portfolio should be 12.06. And if I want to convince someone to invest in Kanyaka Limited, the return should be 13.60. Now let's see further what the question is actually asking us. You are required to calculate the following. What is the expected return based on CAPM, and also if the market goes up by 2.5%, market goes down by 2.5%, market gives negative return by 2.5%. See, up and down, what do you mean by up and down? Up and down means if the market becomes 14.5% and down by 2.5 means if the market becomes 9.5%. And if the market gives negative return of 2.5 means totally negative 2.5. At that time you will have to calculate the expected return. Put these values and then you can calculate it easily. See, let's first calculate the portfolio beta, which comes to 1.015. Okay, then we calculated 13.60 and 12.06. Okay, this much of the calculation was completed by us. Now calculation of expected return based on CAPM at present situation. What is the present situation? Market return. No, it's not, it should not be present situation. Down. Just change couple of things. This is the present situation. There is a printing mistake. Goes up by 2.5%. Do you really think there is something difficult in this question to find out the answer? In whatever the calculation that you have made, you just have to change the market return. In this one, keep market return as 14.5 because it is going up by 2.5. So 12 plus 2.5, 14.5. In the second one, keep 9.5, and the third one, keep directly minus 2.5 because it says it gives, not going up or down, it gives negative return. So see what we have done in the first three part. This is the present situation, and then these are the three part. Goes up by 14.5, then what we have done here is risk-free rate of return this much, beta of the individual security and the portfolio this much. This is the new market return. New market return minus risk-free rate of return is the premium. This 6.5 premium will be multiplied with the beta and then we added with the risk-free rate of return. I think they should have instead used the equation format instead of this entire table format. The table format is going to take a lot of time. It is not suggested for exam. Make sure, and this is your final result. And when it goes down by 2.5, you will keep the market return as 9.5. Rest of the calculations are same. Then when it gives negative 2.5%, you will keep negative 2.5. Now let me tell you, let's start with the equation. Kanyaka Limited, RF plus beta in bracket RM minus RF, so it will be 8% plus 1.4. Market return negative 2.5 minus risk free rate of return is 8%. So see, the calculation will be like this: 8 minus 2.5 minus 8 is minus 10.5 into 1.4, so it goes to minus 14.7, and your security should give a return of minus 6.70, right? If the market is giving negative return and you are still investing in the market, see, I will give you the logic now. If the market is giving you negative return and you are investing in the market security, this Kanyaka Limited, and the risk of our security is higher than the market, 1.4 is higher than the market, then your loss will also be higher than the market, and which is coming to 6.70. If the portfolio, see, this portfolio's beta is very close to the market beta, which is 1. What is the market beta? 1. So can I say that the beta of the portfolio is very close to the market beta? That means the return of the portfolio will also be very close to the market return. Market return is minus 2.5 and the portfolio return is minus 2.66. Almost close. Got it? Always. It is always coming to closer to the portfolio market return, right? So that's it. Nothing else is there. I think this was the easiest question that they have asked in July 21 old syllabus. And it is asked in the old syllabus, but do not consider that they cannot ask you in the new syllabus. The syllabus is same. The portfolio management chapter was same in both the syllabus at that time. Okay, if the probability of market giving negative return is more, see, now this is something logical or analytical. Please advise Mr. X whether to continue the holdings of Messrs. Kanyaka Limited or to buy the portfolio as per the suggestion of Mr. Y. If so, why? It's very simple. The entire question is asking that the market's giving negative return, the probability of market giving negative return is higher. And in that case, any portfolio with a higher beta is not suggested, and we have already purchased the shares of Kanyaka Limited, which has a beta of 1.4, which is very high. You can invest instead. You can just scrap all this money, sell the shares, and then invest in the portfolio if you want to stay in the securities only. When the market is giving negative return, I will suggest you to get out of the market. When you think that it is going to give you the negative return, I will suggest you to get out of the market and invest in the risk-free security only. At least you will earn 8%. But if you still want to be in the market, it's better to be in the portfolio like this, which has a beta of 1.015, rather than having a beta of 1.40. So they are asking our suggestion whether to continue the holding of Mrs. Kaneka Limited, no, or to buy the portfolio, no. The answer in both the cases are no, because the answer is negative. Right? Wow. Who would want the negative return? It's better to invest in the risk-free securities. Let's say what they are suggesting us. If the portfolio of market giving negative return is more, it is advisable to Mr. X to buy a portfolio suggested by Mr. Y because the beta of the portfolio is less than the Kaneka Limited. That's okay. If we only have these two options, portfolio or Kaneka Limited, then the go for portfolio, the losses will be lesser. But if you have the option of Kaneka, portfolio and risk free, then go for the risk free. At least you will earn 8% instead of minus return. Na? So they are considering it as we have only two options, Kaneka and portfolio, and in that case go for the portfolio is my advice to you, because the risk is lower in that. Okay, that was the question. I think that was the easiest question. Let's go on to question number 28 now. Now from question number 28 onwards, we have to mix two types of concepts. The capital asset pricing model, have a look. From 28 onwards, capital asset pricing model and the Gordon's growth model. So the concept from the security valuation will be helpful here. Gordon's growth model was used to calculate the market price, and the formula was D0 in bracket 1 plus growth divided by cost of equity minus growth. So how this CAPM will be useful in this formula? I will tell you. With the help of CAPM, we calculate the required return of investor, and cost of equity also means the same. It is the cost to the company, but it is a required return of the investor. So whenever the market price has to be calculated, there will be two steps. The first step is to find out the market price using this formula, but before that we will have to find out the cost of equity, for which the data related to CAPM will be given in the question, like beta, risk-free rate of return, market rate of return. With that information, you will have to first calculate cost of equity and then put it here, and then calculate the market price, and then suggest whether it is overvalued or undervalued or correctly valued. That is the ultimate decision. Let's start with the questions. And there are lots of questions on this. Some will be homework, some will be done in the class. Easiest one to start with. XYZ Limited paid a dividend. Underline. Start underlining. Paid a dividend means this is D0. And now you might be thinking that we have again started security valuation chapter. Yes, sir. So dividend has already been paid. Whenever the word paid, current, past, such type of words are used for dividend, it is D0. And whenever it is said that expected, next year, proposed, it is said to be D1. Okay, the dividend is expected to grow at 40% for the next 5 years and 15% per annum thereafter. This is a two-stage dividend discount model. For the 5 years, the growth rate is 40% and 15% perpetually. The return on 182 days treasury bill is 11%. This is nothing but risk-free rate of return. Treasury bill, man, treasury bill. 11%, and the market return is expected to be 18%. This is market return. Very simple. The variance of 24% for market. Market return is expected to be around 18% with a variance of 24. So this is standard deviation of m square. Am I right? The covariance is 30%. Covariance of XYZ with market is 30%. Okay. You are required to calculate the required rate of return and intrinsic value of the stock. I will tell you how. There are three things now. Instead of two, there are three things that you will be working on. First, the ultimate thing that you want to calculate is the market price, which is the formula, with which the formula is this D0 in bracket 1 plus G divided by cost of equity minus G. But before that also, let's start. This is not an easy question as such. Question number 28. It's easy, but it's a lengthy question. So 1, 2, 3, 4, 5, and then perpetually. So we will have D1, D2, D3, D4, D5. Then what to do? We will calculate. We used to calculate MP5 here. And the ultimate thing is calculating the market price at 0 point of time. So what we are going to do? We are going to get the present value, calculate the present value using cost of equity. Okay, using cost of equity. Also, the market price at the end of 5th year will be calculated using D6. Remember that. Whenever you use the market price at the end of 5th year, D6 means next year's dividend is required, divided by cost of equity minus growth. Okay, it's very easy to calculate the D1, 2, 3, 4, 5, 6, but we don't have cost of equity. And unless and until we have the cost of equity, we cannot move ahead. So let's first find out the cost of equity. The cost of equity now will be calculated using CAPM method. So cost of equity is equal to risk-free rate of return plus beta of the stock into market return minus risk-free rate of return. So required rate of return or KE, you put RI or KE, one and the same thing. The meaning is required rate of return. We have RF, RM, RF, everything, but we do not have the beta. So we will have to first calculate the beta. Now what is the formula for beta? Covariance of IM divided by standard deviation of M square. Right. So covariance of IM 30, standard deviation of M square 24 square. That's 576. But they wanted to say 30 or what? Acha, variance is 24. That's my mistake, and that's a lot of people are going to do it. The thing is, they have already given you the variance. Read this word. 24 itself is a variance. It's not a standard deviation. So 30 by 24. You reached at 1.25 beta. Now just move a step upwards. 1.25 is the beta. Market return and risk-free rate of return 18 and 11%. So put the figures 1.25, 18 minus 11 and 11 here. So the cost of equity is 19.75. Now put down 19.75 here, 19.75 here for discounting the cash flows and the growth rate. See, the growth rate is 40% for the first 5 years and 15% thereafter. So 0.15. D6. For the D6, you need to increase the D0 for 40% till 5 years. Should I do this calculation now? Because we have seen lots of working or lots of question on this method. You just have to increase the dividend by 40% on each case. Then from D5 to D6, it will be 15% increment only. And then you will get all the figures required. You can calculate the cost of equity. You can calculate the market price with the cost of equity. See. So this is our first answer. With that answer, we have calculated the second answer. And with that, these are the 40% dividend. And this is the 5th year's dividend, 40% dividend. So this is the D1 to D5 present value with 19.75%. And then the present value of the terminal value is calculated here. See, 10.76, an increment of 15%. That means you are calculating D6 in the numerator. Then cost of equity minus growth. And this is the present value factor because this is nothing but MP5. So 5th year's factor will be applicable. You add this and this, you will get the market price. Simple. Beta to equity to Gordon's growth model. So you used this formula, CAPM, and then Gordon's growth model. Okay, come to this question. Take this as homework. Same to same. See, growth rate of 10%. Paid a dividend, that means this is D0. Market portfolio return. Beta is already given. You don't have to even calculate beta. In the previous question, we had one extra working. In this, it's even easy. This is RF. You will have to do this question. Beta, growth, paid dividend, risk-free rate, market rate. repetitive in nature. Do not do it for exam, just for the practice. It is just for the practice. This is something interesting. Have a look. Paid dividend, that means this is D0. Face value 10 in the financial year ending 31st March. Okay, current market price is already given to us, that is actual market price. Growth rate is given to us. Beta is given to us. Average market return is given to us. Risk-free rate of return is given to us. Intrinsic value is calculated using this formula. I think this can also be taken as an homework. Nothing's new in that. See, market price to be calculated as D0 in bracket 1 plus growth divided by cost of equity minus growth. You have the D0, that is 2.5. You have the growth rate, which is 10%. Okay, the only missing figure is cost of equity, which will be calculated as RF plus beta in bracket RM minus RF. You have RM, you have RF, only thing is beta. Beta is also there. What else is required, man? Forget about this homework. See, dividend per share, take it as D0, growth rate G, beta is given, current market price is also given. If there is something new, then I will do it. Na? Market rate of return, risk-free rate of return. Calculate the price of both the shares of the company. Easy, easy, easy. See, beta is given, you have used the CAPM to calculate the cost of equity. These are the growth rate. And this is the dividend. 4 into 1.10 means adding the growth. You have calculated the market price 133 and 81. Till that point we have learned in the previous chapter also and now in this chapter also. Write the comment on the valuation on the basis of price calculated and current market price. See, this is theoretical market price, but the actual market price is given to us, right? Which is 150 and 70. So the actual market price is 150 and 70. Now tell me, which share is overvalued? It's very easy, sir. 133 should have been the price. It is 150. Higher, overvalued. This is lower, 70. Undervalued. Overvalued, undervalued. Not to invest and invest. Undervalued share should be purchased. Overvalued share should be sold in the market. See. Alternatively, if the given figure of dividend is considered as D1, why I will tell you they have given the alternative answer, because the dividend per share in the question is not clear whether it is D1 or D0. And I told you one thing in the security valuation chapter, when nothing is given, consider it as D1. So you can consider it as D1 also. So whatever you are considering in this question, you have learned one thing. When it is nothing, when it is not cleared, you can take it as D0 and D1 also. But the only thing is, make sure you are giving a proper note of it in exam. So that was question number 32. See, what was there in the 32? We first calculated the theoretical market price using given data and then compared it with the actual market price and then decided whether the shares are overvalued or undervalued. If the shares are overvalued, sell the share. If it is undervalued, buy the share. Okay. Now comes the question number 33, which is based on the same concept. The existing data has been given to you and the revised data is also given to you. The data is changing. Calculate the market price, if theoretical market price in each case. What you need is this: market price is equal to D0 in bracket 1 plus growth, paid the dividend D0, cost of equity minus growth. So you will calculate cost of equity using two different data, existing and revised data, and these two different cost of equity will be used to calculate two different market prices, which will be compared with the 25, and then we are going to represent whether it is overvalued or undervalued. See, beta with the existing rate of return and revised rate of return. So there are two cost of equity, and with these two cost of equity 20.4 and 15, there are two market prices. If you compare it with actual market price, this is theoretical market price of 25. We will say that this is overvalued because 25 is the actual market price now, which is higher. And if you compare 36 with the 25, we will say that 36 should have been the price, but it is only 25. It is undervalued. This is sell, this is buy. Anything difficult in this question? No, sir. This is homework. Same. 33, 34. Now this is going to be something that we will be focusing on. Again the same. Okay, what to do in this question? I will just tell you. This is the similar question as that of question number 30. It should have been placed there. Similar. See, current year dividend. This is D0. 40 is the actual market price. Dividend. This is for the current year and the next year. Paid or anticipated per share. This is the current year and this is the next year's dividend. Risk free rate, market risk premium. Please understand this entire thing. Write down one thing. RM minus RF is given to you. This is something tricky which is given in this question. They have not written it as market return. This is written as market risk premium. This is already RM minus RF. Beta expected growth. Same thing. Buy, hold or sell. 40 rupees is the actual price. You calculate the cost of equity in this case and in this case. You calculate the market price with the two cost of equity. Then compare it with 40 rupees and 40 rupees. And then tell me 40 is higher than the previous market price, overvalued. 40 is lower than the previous market price, undervalued. One and the same thing, man. 34 is... Acha, 34. Why did I discuss 34? I told you that it is an homework. Okay. That's my mistake. This is not equal to, this is not exactly as question number 30. This one is as question number 30. Similar to question 30. See, paid a dividend, that is D0. Market rate of return RM. Risk-free rate of return RF. Beta factor is given to you. And it is likely to increase to 1.75. Whatever the decision that they are going to take. Now the question is asking you, you are required to find out under the CAPM the present value of the share, means taking beta as 1.5, calculate cost of equity and then market price. But then if they take some decision, the beta is likely to increase. So again, taking beta as 1.75, calculate cost of equity and market price. They are asking the same thing, to do the same thing twice and with these two beta, 1.5 and 1.75. Is it difficult? No, sir. Do the practice. And this is the question where we are going to start our proper discussion. Question number 36. Let me take a break and I will be back with you.